Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth. I hope you had a great holiday season there. We are done with that. We're back to Fin Tips here. This is a short series that we do. Look at our playlist there. You can see just real short videos to cover really interesting topics. I learned something over the holiday break. I got a chance to talk to a lot of very close to retired individuals, people that are in retirement. Did some things locally here. We're based in Florida, so we work with a lot of retirees. And I learned something interesting. Everybody was asking about the risk that they're taking in their retirement accounts. And yeah, I get it. The markets are high. Everybody's like, well, should I take less risk? But that was the only question I got asked. And I also learned that everybody thinks of their retirement as one thing, right? All their accounts, one, right? And they go, well, maybe I'll just invest everything less aggressively, right? Well, okay, why can't we break it up into pieces? I never wonder why people ask that. It's like if you go to a theme park, and someone says, you want to ride that roller coaster? I'm asking questions, right? Like, how many times does that thing go upside down? I see 2 loops, but where are the other ones I can't see? How fast does it go, right? I want to know how long the line is. Do they ever have to stop this thing so they hose off the seats because people threw up everywhere? I'm asking questions, and I want you to ask questions as well. When it comes to your retirement, if you're 5 years away from retirement, if you're in retirement, how much risk do you take, right? You now know there should be some questions. Well, how often does the market fall? And how far does it fall when it does fall? What's the length of time that it falls, like for a recession? How long is that? For a recovery, how long does the market typically take to recover? Because if it only takes 5 days, then I know I can be as aggressive as I want, because when the markets fall, it's only 5 days on average, I'm good to go. That's not the case, so we have to ask these questions. I've actually done a lot of classes for our customers in the dojo. It's a private library that we have where we do classes every week for our customers, and we've done a lot of them. If you happen to be one of our customers, the most recent one is in our 2020 Market Investment Outlook, where we talked about market when they fall through recessions. I'm going to help you guys cover some of that today. We've also done stock market decline statistics. There's all kinds of great stuff in here for you if you are one of our customers, so be sure to check it out. I want to help you out, and make sure you're asking the questions. And if you don't know the questions to ask, I'll just throw stuff at you until you start asking questions. That's what we do here. Anyways, okay, I want to illustrate this for you. You should be asking now, if I want to take more risk than maybe the average person, what am I up against? So let's take a look here. Since 1945, we went back to 1945 and we said, okay, we want to measure so let's say the markets are doing whatever they do and they hit a top, right? We don't know when that top is going to happen, but when the markets hit a top, we want to know how long is the eventual decline? What do we have to suffer through? Is that decline typically 5 days, 5 years, 10 years? What is it? Well, if we go back to 1945, just after World War II, the average length of time that the market goes from a top to whatever the eventual bottom ends up being is 1.25 years, right? 1.25 years is the amount of time that you have to suffer. Now, we're going to account for that in a second. So remember, 1.25. The actual worst was 929 days. That was the 2000 crash there, dot-com bubble there. 929 days, which is about 2.5 years. So 1.25 years is the average over the last 10 recessions. But 2.5 was actually the worst if you want to account for the worst. So you remember those numbers there. Now that we know that, we know, okay, it's not horrible, right? I could take some risk with some of my money because the average decline isn't so bad. But how long until I recover all of my money? Meaning I want to get back to this point or better. How long is that going to take to get me there? That's the real one, because if that time period is really short, then you can afford to take more risk. Because think about it, if you're retired and you're drawing from your accounts, you only have 1.25 years, let's say 2.5 years there for the max. And then if we have a short amount of time here, then it's not so bad. We can draw from our accounts a little extra money when the markets are moving higher to account for that short time period when it's going down. But here, stick with me here for a second. Okay, how long does it take to recover, get back to even there? The average is 3.6 years. So 3.6 years to fully recover from any drop. That's the average over the last 10 recessions since 1945, okay? The longest one, by the way, was 2,744 days. That, believe it or not, was not the financial crisis there. That was actually 1973 to 1980. July of 1980 is where it finished off there. That's about 7.5 years. I did the math just a second ago because I was kind of astonished by that. So 7.5 years is the max, all right? So here's what we want to do. We want to ask these questions. We know what we're expecting here in terms of averages, right? We've got to start with something. You may not want to use the average. I get it. You can give me a hard time for that, but we got to start with something to make a plan. So here's what we want to do. We want to break your retirement dough into categories. Now, every one of our customers knows how much they need to save so that when they retire, they can pluck however much they want out a year. Let's say it's $50,000, $60,000, whatever it is they're shooting for in retirement income, we actually work the numbers out that way. So what we're going to do is we're going to come up with a couple different pies here. I'm going to use pie because everybody else uses bucket, and I'm trying to be different. Can you tell? So what we want to do is we say, okay, we know that there's risk to investing with our retirement. The markets are going to fall at some point. They're going to recover at some point. Then they're going to do it again, and then they're going to do it again. So we know that's a part of the game that we have to accept. What we don't want is to risk all of our money in the market. So what we want to do, knowing that the average from top to bottom, let's call it 2 years. It was 1.25, but let's call it 2 years. Knowing that, we want 2 to 3 years of really safe, liquid investments. Not investments, money, right? So we want 2 to 3 years sitting on the sideline. I can't tell you what to put the money in, but it could be something like CDs, a high interest savings account. It's not really high interest these days, but you get what I'm saying. Something really, really safe, money market where there's technically no risk, and you can have access to the money at any time. 2 to 3 years. That stops you from having to withdraw money from your account when it's falling because you've already got the cash on the sidelines. Little sneaky trick I'll tell you about here. I don't actually tell customers about this one. So I've told one guy, actually, he's in Chicago. When the markets are going up, if my customers are retired, I actually start selling little pieces along the way so that they have that cash. Not a lot, just building a little bit along the way. So when the markets fall and they say, oh crap, now I have to take money out and the markets are falling, I've already got a little money saved up for them. So just a little extra thing that I like to do for them. Not a lot, but I'm just telling you. Okay, so 2 to 3 years in ultra safe investments. Now, that helps us weather the downturns on average. We will not have to draw from our investments while the markets are falling down. Now, I want you to go over here, 4 to 10 years of your years 4 through 10, not 4 to 10 years, years 4 through 10. Think of your retirement in this category. Years 4 through 10, I want you to be a little bit more aggressive. I wouldn't even use the word aggressive. Let's just use the word moderate, right? I'm going to say moderate investments. You could be somewhat aggressive with this money because you likely, if you get stuck and the markets start to fall, you likely will start drawing from that during a recovery. It's not perfect. I'm not saying it's going to happen every time, but that's probably the case. You'll start drawing from that. And it's not that you want to be aggressive during that point. You want that money to be growing faster so that on the way up, if you have to start dipping into somewhere years 4 through 10, the market's trying to recover, you've got investments that are growing faster and they're not just sitting there stale, not growing, right? So we could be a little bit more moderate with years 4 through 10, years 1 to 3 essentially. I should have put a 1 there. Very conservative, all right? We can make these decisions based on the what I just showed you, the data of what I just showed you there, okay? So what's next? The rest of it. The rest of it is about 60%. Now, I'm assuming that you will have already hit your goal. You have enough money. You are able to withdraw the income that you need yearly from your retirement and everything. I'm assuming you're going to be able to do that. If you're still playing catch up, then you're going to need to play catch up before you do this here. But years, everything beyond year 10, you can be aggressive. Go for growth. You ever hear Dave Ramsey say, just invest in those 4 funds your whole life. I don't care. Be aggressive. I don't 100% agree with that, but what he's trying to say is, look, a lot of this money you're not going to touch for years. If you're not going to touch it for years, then you can weather ups and downs and all that sort of thing with that piece. Not with that piece and not with that piece, right? But with that piece, we could be aggressive. This is so important. I get fired up over it here, but the idea of missing out on gains while you're retired because you were too scared to be aggressive with some of your money is just wrong, right? That could be an extra 3, 4, 5% there that you're missing out on. And when do we have the most amount of money saved up? When we're retired or very close to retirement. So 5% on a big chunk, that's a big deal, right? Now, if you're a kid, you're 20, you're 30 years old, go for it. Be aggressive with everything. You got plenty of time. Now, you know that because of the data that I shared with you. All right, I hope that helps you guys out there. Welcome back. I do appreciate doing these, you guys watching these videos. I love doing them. We will be back again later today. We do a show. It's called The Closing Beat. It's an update on the stock market for the day. We'll cover all the good, the bad, and the ugly. A little bit ugly out there lately, huh? We're going to cover it later, so I hope to see you then. Thank you so much for watching. I hope you found this useful. If so, maybe hit the subscribe button and all that great stuff. And I just appreciate you guys watching. Enjoy. We'll see you later.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.